Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. So let me give you a rundown on what we've got to talk about on today's show. First up, we're going to talk about a topic we've actually visited on a recent previous show, and that's the subject of the temptation to pad your deductions. Of course, it's tax season. You're all having your tax returns done, or you're doing them yourselves, and there can be the temptation to, we'll call it fudge the numbers. I'm going to talk about why that's not a good idea and what some of the repercussions of that can be, because it's a focus of the IRS right now. We're joined by our financial planning pro and my partner at Randall Financial Group, Matt Sweet. We're going to be talking about an interesting topic. This comes up regularly with clients, and it's the question of whether owning your own home is in fact a great investment. It's many great other things, of course, and that's not what we're here to talk about. But is it actually a good investment? So we're going to talk to Matt about that. We're going to talk about something that I just learned about recently. Now, I've been in this business for over 20 years, and it always amazes me, but it should not surprise me, that there's stuff I don't know. And I recently learned about a long-term care benefit that is specifically for military veterans. And it's a valuable program that I don't think enough people know about. I, for one, didn't know about it until recently, so I want to share it with the Money Pros audience. And then finally, we have a viewer question on the subject of gifting stock from a mother to a son that I want to share the answer with you to as well. So lots to get to on today's show. Let's leap right into it. First up, we're going to be talking about something that we had our tax pro on, Greg Picaro from Trander Picaro and Associates. We're talking about something called the IRS Dirty Dozen, which is a list of the top 12 issues that the IRS focuses on. And one of the things on the list that we talked about briefly was the subject of padding deductions. And I want to dig into this a little bit more because I recently saw an article in Forbes magazine that talked about how much the IRS is actually focusing on the issue of padding deductions. So what do we mean by padding deductions? Well, we're talking about fudging the numbers when you're doing your tax return. Some examples might be, for example, when you do your charitable contributions, instead of actually using the number that you can back up with your checkbook and receipts and things like that, maybe throwing in another couple of dollars, or maybe in some cases more than a couple of dollars. Charitable deductions have a big impact on your tax return. Every dollar that you donate generally is not taxable, so it can mean a lot less of a tax burden if you're tempted to up that number beyond what you actually gave. Bigger and more common examples of padding deductions usually result with people that have businesses, whether you're a Schedule C filer or S corporation or some other format. There's a lot of opportunities to pad deductions with business expenses, travel, entertainment, a whole variety of things where mileage on your car is another example, where you may be tempted to bump up the numbers to higher than what you can actually substantiate with your records, because the temptation has a financial benefit, obviously. You can get either more in a tax refund or at least less tax liability the higher those numbers are. But the point is, the IRS is on to this, and they have some very sophisticated methods that they don't share with the general public about how they determine where there's a likelihood that this is happening. And if it does happen, the penalties, the repercussions could be substantial. So let's talk about them. I'm going to put up a slide. We'll talk about these things one at a time. The first thing is taxes and interest. Now, it should come as absolutely no surprise to you that if you get caught doing this, you're going to owe the taxes on the money that you otherwise excluded from padding your deductions. So you're going to have to worry about that. You're also going to have to pay interest on those taxes that you didn't pay. So you're going to accumulate a higher tax burden than you would have had you just been honest in the first place. Next thing is you're going to have to deal with penalties. The penalties can be substantial. 20% of the disallowed amount for filing an erroneous return, potentially $5,000 for a frivolous return if the info you provided was clearly incorrect. And generally the penalties range from 25 to as much as 75% of the amount you owed. It can be that high if it's determined that it was in fact tax fraud. Finally, and this is possibly the worst thing, you could be subject to civil or criminal prosecution. And I'm here to tell you that the defense of, well, I just didn't know, that's a shaky defense in the eyes of the IRS. So all of those things add up to, it's probably not something that you want to go lying about. Make sure that whatever deductions you take on your tax return, you actually have the proper substantiation for. So let that be a cautionary note from those of us here on the Money Pros. All right, up next we're going to be talking to our financial planning Money Pro, Matt Sweet, about the wiseness of investing in a home. So stay with us, there's more to come. Welcome back to the Money Pros. I'm joined now by our financial planning Money Pro and my partner at Randall Financial Group, none other than Matt Sweet, certified financial planner and enrolled agent. I failed to point that out, but whenever you have letters after your name, you gotta point them out. So we are going to be talking about a topic that I actually find comes up. I don't know what your experience is. We haven't talked about this offline all that much. Comes up all the time with clients. One of the things that I ask prospective clients early on in our relationship is, what do you think the best investment you ever made was? And I will say the top answer, and at 9 out of 10 times the answer I get is, it's my house. So let me ask you this question to open up, because this is the subject we want to talk about. The American dream, so to speak, has always been about home ownership. But do you think that that dream or that attitude has changed any, particularly since the 2008 financial crisis?
I think our attitude certainly has changed about it, but I'm not sure that, that it's completely out of reach anymore. All right, I think maybe that's the way we view it, is that things are out of reach for today's people that are.
But do you think people still have the same ambition to own a home? Does it hold the same cachet that it did, or is that perspective changed?
I think it does. I think it does. Yeah, I think people are afraid to do it, perhaps.
Okay.
They're scared off a bit. But I think there's definitely a desire.
So like I said, a lot of people will cite their home as their best investment. They'll have lots of horror stories about mutual funds and stocks and things like that. But then they'll look at their house and say, this was a great investment. Why do you think people think that?
I don't know. I think they perceive a house as a stable value, for one thing, and that houses can treat you well. They can give you some place to live and provide happy memories, and they do tend to appreciate over time. They increase in value significantly over the long term. So I think that is really what people are looking at. They're looking at, well, I bought this house 30 years ago for $50,000, and now it's worth $250,000 or $300,000.
I think that's that's what I notice the most often is you talk about the stable value, and unlike people's brokerage statements where they get one every month and they see what the value of the statement is, or they can look up online and see what the value of their portfolio is on a monthly or weekly, if not daily or hourly basis, you don't have that same feedback with a house. So the sensation is that there wasn't the volatility in the value that you would have had with some of your other investments. Do you think that plays a role?
Absolutely, absolutely. Because people don't think, oh, well, housing prices are down, so I've lost money. Right? Whereas if in a stock portfolio, you say, oh, stock prices are down, I lost money.
Right, so you're much more conscientious of it. Yeah. Now, we talk about the fact that real estate does, in fact, appreciate in value, right? And generally residential homes appreciate in value. But what are some of the things that people, as they're considering their home as an investment, probably aren't factoring into the equation when they're actually figuring about, well, I bought it for 50, now it's worth 250, where am I at?
Yeah. Well, there are a lot of costs that go along with just maintaining a home, and including the insurance, annual insurance payments, your taxes every year. Now, you don't think of that as a maintenance item, and indeed it's not, but you need to pay your taxes to keep the house.
It's a carrying cost.
It's a carrying cost, exactly. And then the maintenance costs. And not only that is that, in a sense, you need to upgrade your house through the years too. If you still have the same plumbing system that was, say 50 years ago, it needs to be upgraded. Same with electrical. You can't stay the same. You have to actually improve it over time.
And so the plant and equipment, so to speak, is depreciating. Yeah. The land isn't going to depreciate, but the house itself is going to depreciate. Yeah. So in an effort to, keep up with that depreciation, you're going to have to put in money for repair, so that new roof, new bathroom, all of those things are going to be sort of part of the cost. So do you find that when people are sort of doing the math and they look at that 50 and they look at the sale price for 250, they're doing the back of the envelope calculation, but they're not thinking about what they spent on it over time?
And then you start adding interest, the interest that you paid to buy the house, and things can even reverse even more.
So that, the interest, I'm glad you brought that up because that's something that I wanted to ask you about. We don't often talk to clients about the concept of leverage, but how cognizant do you think clients are about the fact that, now you raise the interest cost as an expense, but the fact that most people are comfortable with the idea of buying a home with a mortgage,
Yep.
which is by definition a leveraged investment,
Yep.
versus the concept of maybe buying stock on margin, which is another example of a leveraged investment. People have two completely different attitudes about the risk level of those two things. What are your thoughts about that?
Well, I think they're right to have the difference in risk, partly because buying a house, you're not just buying an asset, you're buying someplace to live in, and you need a place to live in. So it solves a serious problem that you have. In other words, provides a roof over your head. But also, a house is a long-term asset, so it's appropriate to have a long-term liability kind of pay for it over time. I think anyway.
Well, and I'm gonna disagree with you.
Okay,
Well, I'm not so much disagree, but I want to. The point that I want people to understand is that leverage magnifies returns.
Yes.
And so when I think the days of people living in a home for the duration of a 30-year mortgage, that's pretty unusual at this point.
Mm-hmm.
I think people. My experience is that people live in a home for 5, 10, 15 years and then they move on to something else, whether it's a bigger home or a smaller home because they downsize or whatever the reason is. So they're looking at the differential in prices over a shorter period of time. The leverage plays a role in the return, and because people are comfortable taking out a loan, it enhances the return, and they compare that to other investments that were unleveraged and had less return. I don't think it's a fair comparison.
No, that's true. That's true.
So talk to me about home improvements, because one of the questions that I get from clients a lot of times is, they have money sitting in their portfolio. Oftentimes it's designated for retirement or some other things, but a lot of other times it doesn't have sort of a specific designation. And they want to do something to their house. I mean, I did a large addition to my house at one time. People do kitchens, bathrooms, pools, all kinds of things. How do you counsel clients about whether that is a good quote-unquote investment?
Yeah, I generally take the same approach with almost anything. If it's something you want to do it because it's something you want to do, not because it's a potential investment in the house. Because as far as a rate of return, it won't give you a very good rate of return. You can't expect to kind of make money on your new kitchen, but it will provide extra value for the property. In other words, the value will increase, but it may not increase by the amount of money you spent.
And I think we see that a lot of times with the statistics. We've even talked about them on the show with our real estate pro and things like that, that even the best payoff improvements are generally some percentage of the expense, right? So if a kitchen returns 90% of the value, it's another way of saying you just lost 10%, right?
Exactly.
So that's definitely an issue. So your point is focus on whether or not it's something that's right for your lifestyle. It's really an expense. It's not an investment.
Right.
Don't use the investment
Excuse.
cloak as as a way to make it a little easier. Another question that comes up all the time that's obviously related to the concept of a house as an investment is the idea of paying extra on your mortgage. How do you counsel clients about, should their mortgage payments $1,500 a month? Should they be putting in another $100? Should they be putting in another $500? What are the things to consider? Yeah.
Well, I usually tell them if it makes you happy to put a little extra on the mortgage, by all means do that. It will usually reduce the term of it. However, one of the problems is the money that you put on the mortgage now, you don't get to benefit from until it's completely paid off. So, it does give you a certain amount of satisfaction to do that, but it's not always a kind of a good investment. I always think that you want to focus on some of the other priorities first, like retirement planning and making sure you have sufficient money in an emergency fund. So yeah, while paying off money, especially in the beginning of the mortgage, is it can be beneficial as far as shortening the term of it. It's not necessarily a great place to put your money.
I think it's also a tough call in light of how low mortgage rates are. I mean, whether you bought your house 20 years ago or 3 years ago, in all likelihood you've refinanced to a new mortgage, you have a very low interest rate, you're probably taking a deduction for that interest, so your effective borrowing rate is extraordinarily low right now. Paying extra money on that house is not all that amazing a return, particularly in light of how long, I mean, you might have 20 years left on your mortgage. That's the maturity of that loan. You really have to consider it in light of what your other opportunities are. What tips do you offer for people when they're considering buying a house from a financial standpoint? I mean, we're not real estate experts, right? We're not talking to them about 4 bedrooms versus 3 or corner lot versus cul-de-sac. But what advice are you offering them in terms of the fact that it's probably the largest expense they're ever going to have in their life?
Well, I think when you're in the market for a house, it tends to be kind of price inflation. You think, okay, I can afford a $200,000 house, and the next thing you know, you're looking at $250,000 houses. So kind of keep your means in mind when you're looking at what you can afford.
Stick to your budget.
Yeah. And I mean, the rule of thumb is that you can afford to spend 50% of your disposable income on housing costs, and that should be pretty much a maximum. I'd be very nervous about going higher than that.
And that's your disposable income.
Right,
so
not
that's
your gross
significantly different than your
Think of it as
gross
your
or
take-home.
after-tax income.
Yeah.
So you really got to stick to your budget and come up with some sound decisions. But I think something you said earlier on would be my biggest takeaway from this, which is a house is a place to live in. So make the determination from a lifestyle standpoint the number one consideration, and the financial things should come after that, basically. Matt, great information as always. Thanks very much. All right, up next we're going to be talking about a valuable long-term care benefit for military veterans. So stay with us. There's more to come. Welcome back to the Money Pros. So I want to talk to you about something that I just learned about recently, and I thought it would be a great thing to share on the Money Pros, and that is an important long-term care benefit specifically for military veterans. Now, the person that brought this to my attention is a friend of the show, Lynn Riley. She's attorney and partner at Cameron and Middleman here in Providence. We have her on the show all the time. She's an estate planning expert, and she mentioned this recently to a client of mine, and I said, wow, I can't believe I didn't know about this. So I did a little research, and I said, this is something great to share on the Money Pros. So let's talk about it quickly. The program is actually called Aid in Attendance, and it's actually considered a part of the pension benefit for veterans. So it's available not only just for the veteran, but also for surviving spouses. The disabilities that the Aid in Attendance benefit will pay for do not have to be service related. It could be typical long-term care needs of seniors. So it doesn't have to be related to the military service itself. The other thing that's important to know about it is it's a cash benefit. It's not a reimbursement plan. So you merely need to have the expenses, and you can qualify for the benefit. They don't just pay the bill, or the expense doesn't have to go through the Veterans Administration or anything like that. So let's talk about the requirements, because they're somewhat stringent, but not as stringent as many people might expect. And there are a lot of situations under which a veteran could qualify. So let's put up a slide. We'll talk about these things one at a time. The first requirement for the benefit is the service requirement. So this is pretty straightforward. You must have served in the military for at least 90 days, and 1 day of that 90 has to have been during wartime. So you do have to have served during a wartime period. The second benefit is the income requirement. So there are a few different pieces to this. So you have to earn as an income less than the actual, what they call the maximum annual pension rate for the military. So in 2000, and it depends on whether you are the surviving spouse or you're the veteran yourself. There's a few different categories for what the maximum annual pension rate would be for the veteran, but the range is between $13,000 and $25,000. So by definition, you have to have a pretty low income, but excluded from that income are other welfare benefits and supplemental security income. So there's a lot that's cut out of there, but generally you'd probably qualify for this benefit once you've exhausted all other income. The other important thing is that what's excluded from the income is the actual costs you have. So if you have, let's say, an income of $50,000, you might think, well, I don't qualify because I have to have an income no higher than 25. But what gets taken out of that 50 is all of your care costs. So if you have long-term care costs already of $30,000 or more, that's going to be subtracted from your income. So you may, in fact, qualify for the benefit. So the final thing that I want to point out, and I know I'm doing this out of order on the slide, but I just covered the income requirement, is the asset requirement. So you have to actually have less than $80,000 in assets, and that's the final requirement that I wanted to point out. But there are a lot of situations where you could qualify for this benefit. It could be in excess of $2,000 per month, which is a substantial amount of money. So if you're a veteran or related to one in need of long-term care, this is definitely something that you want to look into, perhaps even before you look into Medicaid benefits. So I hope that the audience finds that helpful. All right, up next, we're going to answer a question on capital gains with gifted stock. So stay with us, there's more to come. Welcome back to the Money Pros. Viewer question time, and this question actually comes courtesy of a client of mine. This is an issue that came up recently. I thought it would be a good one to answer here on the show. The question was essentially this: my mother is doing some estate planning. She is considering giving me some shares of stock. We are unsure of how the capital gains taxes will be calculated. Can you explain? So this is a fairly common scenario. An estate planning tactic would be to gift stock to people that would otherwise eventually inherit it to reduce the size of the estate and take the appreciation of the stock out of the estate. But there is a tax consequence here that, in this case, my client didn't actually recognize, and that is that if the stock is gifted, the person that received the stock also receives the original basis in the stock. So what that means is the original investment is essentially the original purchase price of when the mother bought the stock, not the time of when the stock is gifted. So when the secondary person goes to sell it, they're going to owe the difference in tax between the original purchase price and the sales price, not the time in which it was gifted. All right, that's it for today's show. Thanks for watching. We'll hope you'll join us again next time right here on the Money Pros. Take care, folks.